Okay, let's dive right into this. We are breaking down the first quarter earnings for 2026 from Wall Street's biggest banks. And trust me, there's a really fascinating story hiding just under the surface. I mean, on the surface, the numbers look absolutely incredible, right? JP Morgan, Goldman Sachs, they both just blew past what all the analysts were expecting. But if you were watching the stock market, you might have scratched your head a little. The reaction was kind of meh, even negative. So what gives? Why is there this huge gap between the glowing headlines and the quiet concern from the professional investors? Well, here's the thing. The secret is definitely in the numbers, but probably not the ones you're thinking of. It's not about the flashy profits or the record-breaking revenues. In this explainer, we're going to pull back the curtain and show you exactly where the pros are looking. We are going to uncover a critical warning sign that separates the headline story from the real story. All right, first things first. Let's start where everybody else does, with the big, bold numbers that were all over the news. This is the tip of the iceberg, the part that's really easy to see and get excited about. I mean, just look at this. The sheer power in these figures is, wow, it's undeniable. JP Morgan brings in a net income of $16.5 billion, and a huge part of that was a record $11.6 billion in trading revenue. And their return on equity? A stellar 23%. That's a key measure of how good they are at making money with their shareholders' cash. Goldman Sachs also just posted enormous revenues of over $17 billion. By any normal standard, these are absolute knockout numbers. So the narrative practically writes itself. Deal-making is back. The economy's humming along. The banks are absolutely crushing it. If you're an everyday investor just reading the headlines, this looks like the clearest buy signal you could possibly ask for. But it's not the whole picture, not even close. Okay, now to get the real story, we have to dig a little deeper. We need to go past that flashy income statement and look at a part of the bank's business that's way less exciting but way more important for its long-term health. Now, before we get to the big red flag, it's good to have a quick refresher on the balance sheet. See, unlike a quarterly profit number which can jump all over the place, the balance sheet gives you a much more solid look at a company's actual stability. Think of it like a financial checkup at one single moment in time. So here's the crucial point, the real key to all of this. The past is interesting, for sure, but the market, well, the market trades on the future. And the smartest investors know that what a company says about its own future, its guidance, is often way more important than what it did last quarter. The red flag we're looking for is all about what's coming next. And that brings us to this metric right here, net interest income, or NII. Forget all the complex trading stuff for a minute. NII is the absolute core of what a bank does every single day. It's the profit they make from taking our deposits and lending that money out. It is the bread and butter of banking. It's their fundamental profit engine. And boom, this right here illustrates the whole problem. Buried deep inside that glowing earnings report, JP Morgan quietly lowered its expectations for that core business for the rest of the year. They trimmed their forecast by $1.5 billion. Now, that might not seem like a lot for a giant bank, but it's the direction of the change that has people worried. They're telling us their core business is slowing down. And that brings us to the central mystery of this whole thing, right? Why on earth would a relatively small cut to a kind of boring number like NII spook investors more than a record-shattering, multi-billion-dollar windfall from the exciting trading division? What are they seeing that most of us are missing? Well, the answer isn't inside some Wall Street skyscraper. It's out on Main Street. It's about the financial health of the bank's most important customer. You, me, the average consumer. This is the part of the iceberg that's underwater, and the foundation is starting to show some serious cracks. Just take a look at this. This chart shows delinquencies for subprime auto loans. That's just car loans for people with weaker credit. And right now, the rate has surged past the peak levels we saw during the 2008 Great Financial Crisis. At 6.65%, that's a huge red flag for consumer health. And this stress isn't just in the car market, it's hitting the next generation of consumers really, really hard. More than 15% of Gen Z credit users have used up over 90% of their available credit. They are effectively maxed out, and that is a crystal clear signal of some intense financial pressure. And this strain is hitting hardest in lower-income communities. The rate of delinquent credit card debt in the poorest areas has just skyrocketed to over 17%. So you see, when people can't pay their credit card bills, that directly hits a bank's core lending profits. This is why a bank like JP Morgan is getting nervous about the future. And look, as analysts have pointed out, history gives us a pretty chilling warning here. This pattern of rising delinquencies, it isn't new. It was a classic canary in the coal mine right before the 2008 crash. It's a signal that wider economic trouble could be just around the corner. Okay, so let's put all the pieces together. With all this context, we can now see the two completely different stories that are coming out of the very same earnings report, and we can start to understand why the pros are reacting the way they are. This reveals a classic Wall Street playbook. It's like a three-act play. First, the company posts a big beat on its past earnings, and all the headlines are great. But then, it lowers the guidance for its future core business. And the result? The stock often goes down, because big institutions care a whole lot more about where the company is going than where it's been. And believe me, this happens all the time, not just with banks. As one analyst noted about other big companies, a fantastic quarterly number means very little if the people running the company are telling you that a slowdown is coming. The future always outweighs the past. So here they are, the two stories, side by side. The retail story, the one you get from the headline, is all about a spectacular boom. But the institutional story, the one you get from the guidance and the macro data, is all about increasing risk and a weakening foundation. Two totally different conclusions from the exact same report. And this right here, this is really the brutal truth of the market. The investor's edge, the alpha, as they call it, comes from understanding this dynamic. It's knowing that the real, actionable information is often buried in the forward-looking guidance, not sitting right there in the backward-looking headline. So what's the big takeaway from all this? I mean, the point isn't just to understand this one bank report, but to develop a new framework, a new way of thinking that you can apply to any company you look at from now on. Here's a simple checklist to help you start thinking like an institutional analyst. First, always look past the headline number. Second, hunt down the company's future guidance. Third, scan the footnotes for any one-time events that might be making the numbers look better than they really are. Fourth, connect the company's story to the bigger economic picture, just like we did with consumer debt. And finally, always ask the most important question. Is the core business getting stronger or is it getting weaker? Because now you know the playbook. You know that the fleeting excitement of a one-time gain often means very little compared to the steady, foundational health of a company's core business. So the next time you see those celebratory headlines, you'll know exactly where to look to find the real story.